And also it's different from the interest rate that you have to pay to the bank if you borrow money from the bank. Okay. So what is then the interest rate that the central bank assigns, which is called the 7-day repo? Okay. Because 7-day repo essentially is the interest rate of the central bank, right? Bank Indonesia. That interest rate is the rate that Bank Indonesia is going to pay to the banks if the banks put the money in central bank. So let's say you have bank A, you have a private bank, okay? There's a rule that some of your money has to be put in Bank Indonesia, okay? But that money that you put in Bank Indonesia will receive some interest. That is also the interest rate that the central bank will determine, okay? Which is different than the interest rate that you receive if you put your money in the bank, or the interest rate that you have to pay to the bank if you borrow money. Okay, that's point number one. Point number two is that if you have a bank, and I also have a bank, let's say you have in your deposit you have 1 trillion rupiah, but I have only 500 billion rupiah because my bank is smaller, let's say. And then all of a sudden, one of my clients needs a lot of money. They want to withdraw money in one day. I don't know, maybe the client wants to, I don't know, maybe they want to do major expansion in their business. Let's say they need close to 500 billion rupiah. I cannot release all my 500 billion, right? Because if I do that, I don't have any cash. So what do I do? If that one day, all of a sudden one of my clients came to me and asked a lot of money. So what do? I come to you. I come to another bank and I borrow money from you. Do you assign me interest rate? Of course you do. So that is another type of interest rate, and that is called the interbank rate. Okay? So the repo rate is basically trying to sort of coordinate between the interbank rate and the rate that the Bank Indonesia assign to banks who put their money in Bank Indonesia. Is that clear?
Yes, sir. Thank you.
Okay. By the way, that amount of money that you, the bank, put in Bank Indonesia, that is called the reserve requirement. Okay. In fact, I'm going to give you some example later on about this reserve requirement, because that is also closely related to bond buying and bond purchasing, as well as the money supply. Okay? Any other question before we proceed?
Sir, so you mentioned one way to lure the consumers to buy government bond is by increasing the yield or decreasing the price. But obviously the government can only do so much up to the point that they are not willing. But when they are really desperate in finding buyers, is there any way that the government can do rather than changing the yield or the price of the bond?
Not much. Maybe the only, it's almost like, any transaction. Suppose you want to sell something and then no one wants to buy your product. What do? Of course, first you try to lower the price, right? But suppose even after you lower the price, still people do not want to buy your product. What do? You do some marketing. You're doing some promotions, right? Well, I don't know. Maybe you can say, oh, if you take this product of mine, then you'll be healthy, or you'll be rich, or you will be successful, and so on. All kinds of gimmicks that you can introduce. So the same thing with the government. Maybe in the case of government will say, oh, Indonesian government is very stable. Our economy fundamental is strong, or the future of the economy is great, and so on. Just anything that they will say to convince the buyers so that they want to buy. Okay.
So promotion is
So I guess yeah, so promotion essentially. So maybe the brutally honest answer to that question is nothing. The government cannot do anything. But the more diplomatic answer is that, well, they can still do some promotions here.
All right, sir. Thank you.
Okay. No other question?
Sir,
Yes.
I want to ask a question.
Where are you? I cannot see you.
Here.
Okay. All right.
Kenapa hai?
As you mentioned earlier, that the last way the central bank can help the government is by printing some more amount of money, right? But wouldn't that
Yeah.
affect the economic condition as a whole? Like, wouldn't that increase inflation and everything else? Thank you.
That's good. So that is a typical question of macroeconomics, basically. Yes, because if the central bank print money, that means they increase the money supply, right? And if you increase the money supply, that means it will be inflationary pressure. Yes, the answer is yes, and that's why central bank will not do just printing excessively amount of money. They will do enough essentially. But remember, why they do this? Because they want to help the government. So the purpose is really to make the economy stable. Because if, let's take the extreme scenario, suppose the central bank didn't want to help the government, then the Indonesian economy will be in trouble. And when that is the case, central bank will be in trouble also. You see? So it's a common interest among all those institutions, the government as well as the central bank. And that's why usually central banks in any country is also trying to help the government.
Thank you, sir.
Okay, no other question?
Sir, one more question. Can I? Sir,
Of course.
the introductory of macroeconomics, the lecture says that if the central banks, sorry, if the central banks buy bonds, it will increase the money supply, and it may lead to the increase of inflation and so on. Is it true, or is there any more explanation about that?
No, it's not always true. Because as I said, central bank always have reserve, right? So if they buy the bonds using the reserve rather than printing money, I don't think that will lead to the inflationary pressure. My answer to the earlier questioner is if, for example, the government run out of the reserve, the central bank run out of the reserve and they have to print the money, because the question was about what happened if the central bank print the money, right? But it's not always. The operation of central bank buying government bond is common all over the world actually. This is not unusual. All central banks in all countries they are common in buying or doing some transaction with the government bonds. Okay?
Okay, thank you, sir.
All right. Okay, so let's continue now. Okay, but please interrupt me anytime. Okay, if I'm speaking and then you have some question. So let's try to see one transaction here. And here we are talking about, suppose the central bank wants to increase the money supply. So just imagine, well, like now, for example, the economy is slowing down. Okay, as a central bank, you want to stimulate the economy. So Bank Indonesia tried to stimulate the economy. The other day, they just lowered the interest rate, right? But another way that they can do is they purchase bonds, the government bonds. Okay. So let's let's play, an example here. Suppose the central bank, Bank Indonesia, buy 1,000 rupiah bond. Okay? And I'm assuming the reserve requirement, remember reserve requirement is the percentage of the money that any bank holding that has to be put in central bank, in Bank Indonesia. And let's assume that reserve requirement is 10%. So that means the central bank is buying 1,000. So that means the central bank put the money in the economy 1,000, but then reserve requirement 10%. That means 10% of 1,000, which is 100, will go to the central bank. Okay, so that means the actual money supply in the society is not 1,000, it's only 90. Okay, so let's look at the case here. Suppose the central bank, oops, I have to, hold on, because I have to activate, this is animation here. How do I animate? Okay, here. Alright, so here's the animation here. So let's say there is a bank 1 and bank 2, okay? So when the central bank purchase bonds, central bank has to give the money to the market, right? In this case, they give the money to the bank, okay? Because let's say the issuer of the bonds is bank number 1. So of course the money goes to bank number 1, and that money amount is 1,000. But remember, there's 10% reserve requirement. That means 100. That has to go to the central bank. Meaning what? Meaning that 100 rupiah does not circulate in the economy because it stays back in the central bank. So that means the only amount of money that bank number 1 can use to lend to clients and so on is only 1,000 minus 100, and that is 900. So far so good? Alright, now let's assume this 900 is lent to some borrowers, okay? Now, if that borrowers get the 900 money, of course that borrowers will put that money in the bank. Now, let's assume they put in the bank number 2. So that 900 now goes to bank number 2 here. Okay? So that bank number 2 now has a new deposit, which is 900. Okay? But remember that bank also have to put some reserve in the central bank, which is 10%. So that means 90 has to go to the central bank. So the actual amount of money circulating is only 810. Let's assume again that 810 is lent, and then whoever the borrow money, they put in the bank number 3. So that means bank number 3 receive deposit 810. Again, that bank has to put 10% in central bank, 81. So the actual amount is 729. That continues because in any economy, there's a process of transaction, right? Here I only show you 3 transactions, actually 2. Bank 1 and bank 2, that's 1, and then bank 2 and bank 3, that's 2. But in reality, there are many transactions going back and forth here, right? So there are many, so let's assume there are many, and let's assume at the end, we have, I don't know how many banks, maybe 50 banks, okay? And let's assume when you sum all this new deposit, the amount is 10,000 rupiah. So you sum across here, so 1,000 plus 900 plus 810 plus some number and so on, and the total is 10,000. So, and then you do the same thing for the reserve requirement, because it's 10%, so 10% of the 10,000 is 1,000, so the remaining is 9,000. So the question here is that, what is money supply? Remember 2 weeks ago when we discussed about money supply, money demand. What is the money supply? This is the money supply. So 10,000. Is that clear? That is the case if the central bank is purchasing bonds. Okay? Oh, this is from 2 weeks ago. I don't know if you still remember. So essentially, basically, this is the money supply, okay? And this is the money demand. Remember, this is our old friend, this is money demand, okay? And then in equilibrium, money supply equals to money demand. And this component of money supply is called the money multiplier. Look at your notes again. I don't know, 2 or 3 weeks ago. This is money multiplier. So basically, money supply is equals to money multipliers times the reserve money. This is money multiplier times the reserve money. Now, if you trace back what is this component in the money multiplier? Well, look at, there is a small c. Small c is the proportions of the money that society wants to hold as a currency. And then there is RR, that's a reserve requirement, which is decided by the central bank. So that essentially there are two components here. One is C, which is the ratio of currency held by the society, and then RR, which is the reserve requirement decided by central bank. So between the two, central bank can only decide RR. They cannot decide C. Who decides C? You. The society decides C. So only RR that the central bank can determine. This is the reasons why any central bank actually cannot fully control money supply. They can only control money supply indirectly through this RR. Is that clear? So if you go back to the example earlier, that RR is really, really important because that is the tool that the central bank can be using, this reserve requirement. Now, if you look at the balance sheet of those banks, let's assume, okay, remember in the earlier example, I said there are many banks, right? But let's now assume, and we stop into 4 banks only. So let's assume there are only Bank 1, Bank 2, Bank 3, Bank 4. So let's assume the transaction stop here, okay? Now remember this 100, deposit 1,000, this is money from the central bank because they buy the bonds. They go here, 100, 10%, and then they loan 900, and that 900 goes to bank number 2, 10% goes here, they loan 810, 810 goes to bank number 3, bank number 3 lend, put 10% in the central bank, and then lend 729, and then with bank number 4 and so forth. So let's assume this is the case. Under this equation, if, for example, in the exam, I give you this, and then I ask you, what is then the money supply? You should be able to calculate the money supply here, right? You sum all this, 729, 810, 900, 1000, the answer is 3439. Okay? And since the reserve requirement is assumed 10%, then you know it's basically the reserve money is 343 because that's it, 10% of 3439. That's it.